It looks like we're live on Facebook, Andy. So, mate, welcome. Another Friday.
Mate, good
Wine
to
and
see
wisdom.
you.
Good to be here, mate. And show everyone the wine you're drinking today. We just had a little bit of a laugh. It's a wine that's going to make you way more wise today.
Mate, we'll show you. If you know one wine in the world that's going to make you smarter, we'll show you straight after this intro.
Get it going.
Well,
Mate,
I finally cracked the code, mate. I've been looking for it for years, looking for the smart drink. Now, once upon a time, I remember when I was looking for the smart drink, I came across a Fijian root called the noni juice, and that's for real. It's meant to make you smarter.
I was going to say, you making that up, Andy, or is that for real?
This is for real, mate. The noni juice is meant to increase the amount of the happy drug in your system. What's it called?
Not the endorphins.
Serotonin.
Serotonin.
Increase the serotonin levels. So clearly this hasn't kicked in yet, but this is now apparently guaranteed to make you like Stein and help you think outside the circle.
Think outside the circle.
So it's a Cabernet Sauvignon from God knows where. It says Wine of Australia. Albert, think outside the circle. Bit O Heaven Wines. So they can't spell properly, but that sells them right up my alley. And so, mate, by the end of this, there might be some real genius that'll come out.
That's it, mate. We're hoping. All right. Well, dopamine shouted out. So too did Lauren, gave us the serotonin. But we got a bunch of guys on right now. So thanks for joining us, gang, for another Wine and Wisdom. Awesome to have you guys online. And yeah, hopefully that wine does make us a bit wiser, Andy. If it does work for you, mate, I'll buy a couple of bottles. I'll sit back and see tonight. So welcome everyone. Quick intros while we're here, while everyone's dialing in. Wine and Wisdom each week. Andy and I get together, debrief the week of real estate and the world of the share market and finance. And we have a bit of a yarn. It started ages ago when COVID hit and we wanted to serve our clients, our community. And we've enjoyed it. We've just continued. Fridays, a bit of a wine, bit of a live workshop on Facebook, just to maybe share some of the debrief for the week. And hopefully there's a bit of wisdom that comes out before we drink too much wine. So, that's where it came from. And thanks for everyone being on tonight. So great to have you guys here. Andy, 20 years in the world of shares and the stock market and all things equity, and me 20 years in the world of real estate. And we pontificate, we share, we hypothesize, and we'll see what comes out this evening. We've got a bunch of people online, which is awesome. So everyone who's listening in, if you've got any questions, you got anything you want to throw over the fence for us tonight, please do so in the chat. We're watching the chat as we're going along. Andy and I always prepare a few things that have been in the news or of interest for the week, and we sort of kick the segment off usually with a bit of like what's been in the news, and then hopefully it goes from there. But if you've got any questions, type them in the chat. We will see them, and we'll kick off the evening or kick off the afternoon. Andy, what's going on?
Just before we do, mate, and everybody, I'd love to get your thoughts on this. And by thoughts, I mean whack a thumbs up, like a like if you like what I'm about to show you. Give us a big heart if you think it's funny. Give us a bit of a a laughing face. If you're angry with it, then give us an angry face. But I've got something, mate. So I just wanted to say congratulations on the launch of an incredible podcast. For those of you who don't know, look, I won't spoil it for you, but what I will do is I'll give you a little bit of a sneak peek. So just check out and see if you know who this good-looking and Elvis-sounding man is.
Hey folks, Jason Witten here, your host of the soon-to-be-released podcast, The Wealth Faculty, where we're going to go on an adventure, a journey in discovering what is the true meaning of wealth. Well, what is the wealth faculty? Well, it's two things. The faculty that you bring, your physical, mental, emotional faculties, to the idea of creating wealth for yourself into the future. One thing I can tell you, this thing is a marathon, not a sprint. And we need to make sure that we take care of the faculties that we have physically ourselves to make sure we go the distance in this journey. And secondly, who is on your faculty of educators, advisors, the people you rely on to help you with making great decisions on this journey over the next 10, 15, 20 years, creating, keeping, maintaining and passing on your wealth. Well, we're going to interview the best of the best across Australia and New Zealand together and hopefully discover things. And I'm going to get a chance, gang, I'm going to get a chance to interview my faculty of advisors who've helped me over the last 20 years as a professional property investor, a property investment coach coaching thousands of property investors across Australia and New Zealand, across a table just like this one. And many, many times I've asked the question, what is the true meaning of wealth to you? We're going to discover that answer together on this podcast, The Wealth Faculty. Hope you enjoy.
So, mate, congratulations. That's an incredible podcast. I've already dived into episode 1. Mate, looking pretty dapper there, I must say, and the voice has gone down a couple of octaves. So, mate, doing a bit of voice training there.
Thank you, mate. It's good.
Special microphones that we're using there. But, mate, in all seriousness, amazing. So for those of you, I know that Jason wouldn't give it a plug in this point in time, and this is completely unrehearsed. He's too humble for this kind of tomfoolery. But it's an incredible podcast. The first one was great, in and around the psychology of wealth, which is really pivotal for people to learn because ultimately, we are our own destroyers of our wealth, and we tend to take ourselves backwards. So managing the psychology is so critically important. I think a great one to start off with. A little birdie told me that you're currently at number 6 in the world of podcasts. So please have a look, guys. It is well worth the listen. There's going to be some great stuff on there. I've seen a bit of the agenda of what's to come as well. And but help us get up to that magic number, or not us, help Jace get up to that magic number 1 spot. Let's get rid of Brendan Bouchard. Let's knock off Tony Robbins and get into it. So just Google the Wealth Faculty podcast, and you'll see it there. It's on YouTube, Spotify. It's on Google Podcasts and Apple Podcasts. But mate, congratulations on what's been a really successful launch and a very, very, very high quality podcast, mate.
Oh, thanks, mate. I appreciate it, buddy. Appreciate the bit of a plug. I've enjoyed it as well. And mate, you're on the radar for on the podcast real soon, buddy. So we've got to lock that date down. I'm looking forward to that chat. What a lot of people don't know who are listening in. So I'll give you a bit of a plug back. Andy's brain in and around strategizing when it comes to people's financial matters is absolutely world class, gang. And if you ever get a chance to sit down with Andy and ask him about strategizing your financials, he'll blow your socks off. For those who haven't heard him talk or go through strategy, if you're in our mentoring group right now and you're listening in on the Wine and Wisdom podcast, we did a webinar with Andy a little while ago. It was about 4 or 5 months ago, maybe even 6 months ago. Yeah, and Andy did an amazing hour-and-a-half presentation about the strategy over time, a person's lifetime of different strategies in and around the financial planning world, and also planning for profit and rolling things over and minimizing taxes and capital gains tax management. It was brilliant, mate. So, mate, thanks for the plug for my podcast, but I've got to give you one back for your brain and strategy mind, mate. It's rock star. So, thanks, buddy. So, mate, it's good to be sharing a little bit of time with you today, as always, man. So. Yeah,
just for those of you watching, this is Jason slightly humbled. Have a look at him. he doesn't know what to say. We haven't seen that on Wine and Wisdom before.
Oh, well, let's do something else now, Andy. Stop talking about me.
Well, mate, maybe while you find your mojo there. So just one thing about psychology in general, it's great to be able to take compliments and learn how to take them well. So, Jace, that's what you can work on for the next next.
Thanks, buddy. Thank you.
But mate, in the news, look, we've been talking about this for a little while, and again, I'm going to preface this that this is not advice to go out and acquire any of these stocks, but definitely a thing to watch, both domestically and abroad. And I'm going to bring up a couple of things here, which is really, really interesting, and ultimately, I think is going to, for those of you who watch and have got good counsel, could be extraordinarily good bet for you. But I've been saying it for a little while that there's stocks out there that have been absolutely pummeled, and a lot of people look at the S&P 500 and go, well, America's going great. Well, America's going great because the FANGs of the world, the Facebooks, the Amazon, the Googles, these giant cap companies have really pushed the S&P index, the American index, very, very high. But it's only been then, and we've got these value stocks, and I'll give you an example of them. Let me see, just jump into here. So if we have a look globally, these are the charts for Wells Fargo on the left-hand side here.
Can you zoom in, Andy? Can you zoom in as we go?
No, yeah, so these are the yearly returns. So this is Wells Fargo, a massive bank over in the US, crushed and continued to be crushed. Then we've got General Electric, which is the largest industrials company in the world. Is that gone upside down, or am I looking at? Oh no, that's all right. Largest industrials company in the world, and has been absolutely crushed and hasn't come back. And then we've got Citigroup, right? Citigroup, one of the great investment banks of the world. I hadn't put Goldman Sachs in there, mostly because I was about to use them as a bit of a plug, because we've been talking about some of these stocks. Now, this is while banks are still making very, very good profits. Yeah, which is really interesting for them to be crushed so much. And there's a bit of reason behind that, right? But this is really interesting because it's not often that they'll say that, and if I can bring it up, which for some reason, saying that the slideshow's ended on me, mate. Let me recalibrate.
Have a little look.
But these guys, and they tend to know what they're talking about, Goldman Sachs have actually just made the call. So Goldman Sachs says it's time to buy value. And by value stocks, we mean stocks that actually have tangible forward-looking cash flows, tangible forward-looking profits, not just the story about big growth consumption, which is the large Amazons and so on and so forth in the world. So when we have a look at this as a theme, right, and when we really condense it down, there's a lot of things that we need to take into consideration, right? So we need to take into consideration the fact that yes, unemployment's going to blow out here, offshore. There's a number of other factors that make this difficult to navigate, but globally, this thing's happening. So it's not just the US. Check this out. This is three of our beloved banks out in Australia, going from left to right: Westpac Bank, middle ANZ, and on the right CBA. So you can see a pretty common theme there as well. And just after you can see that they've all had a bit of a tick after the good old budget, stimulus, which is really just a stimulus package, right? You can see that they've all had a little bit of a tick. The market's off a bit today, as we'd expect it to after it had a good run of about 300 points. But again, we're talking about companies that are still have very, very good forward-looking books of cash flow and good profit capacity moving forward. And the banks, we might chat about it a little bit later on, have definitely got a lot of powder dry, which got a lot of
opportunity. Yeah. Well, and it's interesting, Andy, because as we talk about this in the world of equities, you talk about a value stock and maybe a growth stock, or the language is a smidgen different to the world of real estate. You go, oh well, get a blue chip property or a cash flow property, but the concept's the same, right? At the end of the day, all right, what the big investment houses are talking about is like, we're going to back the companies that have already got a strong forward booked cash flow, their capacity to produce income, because that's where the stability is going to be for, I don't know, whatever it is, probably next 12 months or, as they shake out. So, it's an interesting one to see the change in the growth. I've always sort of chatted to you about this idea is like, in the world of the stock market, sometimes those, dividend income stocks seem way more important to me. If I was an investor in that sort of space, I'm thinking, well, I don't want to buy and sell, because I think for me that's too much stress and hassle. Like, I'm not a buy and seller type investor. I just want to buy something and then receive the dividends. So are you sort of saying now that the dividends are looking better, or are you just saying they're just looking more attractive because the investment world is sort of, not convinced of growth? You know what I mean? Like, are the dividends better than they were 6 months ago or 12 months ago?
They're worse. They're worse.
They're worse. Got you. Okay.
Most of them have cut their dividends, and some of them just cut dividends because everyone else was, right? So, Sonic Healthcare cut their dividends. They didn't have to, but everyone else was. So they thought, we'll just retain a bit more profit. Good strategic move, right? Keep some funds in the war chest, and like Churchill says, never waste a good crisis, right? So those boys were smack onto it. Everyone else is doing it. We'll just do the same thing. To hell with it. We'll pay ourselves a bit more. But this is one of the big factors, right? And we've talked about it heaps, is that interest rates, it's the race to zero, and it's the race to zero around the world. So, mate, when you can't get an income from property, when you can't get an income, I've just killed the question there, didn't I? If you can't get an income from bonds, and it wasn't that long ago where we would put money into term deposits, we'd get 4 or 5%, right? And that's all you really need. If you build up your $1 million investment portfolio for retirement, you're getting 5% yield, happy days, right? You probably could get more, but at risk-free rate, that's pretty damn good. But
totally.
Nowadays you get, or 1%. So if you can get 3.5% fully franked, or 3.8%, which is the current sort of average dividend yield, you can certainly target high dividend stocks and get your 5 to 6%. But that soon enough will drive those value-based stocks, and so
drive the capital value, because that income is more desirable. And we're seeing exactly the same thing happen in real estate, mate. At the end of the day, if you take depreciation add backs to real estate out of the equation, for some people they're important, but just take them off the table. You're looking at 4 to 6% on the edge, but 4% at the bottom. But call it a 5% gross yield. Again, you're 3.5 to 4% net in your pocket after your expenses. Interest rates at 2.5%. Money's looking for a home, isn't it?
Yeah. And so we'll see this naturally. And to me, it's a little bit ironic, but people are on the growth story while there is uncertainty about the future as far as lockdowns and all of these sorts of things are concerned. So it's easier to go for the growth stocks based on the lockdown mentality. Who's going to benefit from this? Amazon, Facebook, Netflix. The big companies are going to benefit from it. Ansell. So these are more growth. Well, Ansell wouldn't have necessarily originally be called a growth stock, but it is now. But these companies that are clearly going to benefit from the crisis, but this will wash through, right? And we either learn to live with it, or whatever the case may be. The world will start to get back to some sort of a normalcy. And as that happens, then these forward-looking cash flows, that's when the cycle will rotate back into this value. And it's been a long time, because it's been growth now for many years. Like, the value stocks have been good, but growth versus value, it's been growth for a long time now. But you're going to see that wash through. And even if you just pick them up for the dividends, I look at some of them and I just think, they're bargains. And if you can handle potentially having a period of time where maybe you're down 30%, I reckon some of these value stocks are going to give you 30-40% over the next.
Well, I was going to say, you're probably going to get the best of both worlds maybe in the next short term, in that space, aren't you? You probably get the dividend plus some growth, which you're just going to have
to potentially wear through some extreme market volatility because and we saw it last night in New York. It rolled back out of tech and into some of these others, like GE was up, I think 3%, and some of the banks were up, quite a bit. It's not fully rotated out, but you buy in the wrong time, you could be down 3 to 10 or 15% at any given point in time. But I think looking forward, 3 to 4 or 5 years.
Yeah, I was going to say 3 to 5 years. I mean, at the end of the day, I'm a real sort of buy it and keep it forever type of person. I've never been a buy and sell type of investor in the world of real estate. And certainly when I think about buying some equities and shares, I'm thinking, if I'm going to buy the Commonwealth Bank shares, I'm going to keep them for 10 or 15 years. I don't think CommBank's going away. So in my short term, that short term value volatility won't necessarily, as of now, potentially affect the dividend that much. It'll just be a something that you keep an eye on. But in 5 years' time, you think, yeah, well, it'd be good to own CommBank shares when it makes a comeback. Like you and I were saying, I think the banks, once the gloves are off come March, April next year with some lending, mate, there's going to be some bloody, the banks have to get back to lending. There's just no debate. That's a cornerstone of the government's stimulus plan is the banks have to lend more money to people to invest in all sorts of things. And you're seeing that. I mean, that's part of that. And I didn't get a chance to send you that article the other day, Andy, we were talking about from the ABC, which basically said, listen, the government's borrowed, $1 trillion, and the average interest rate they've borrowed it at is about 1.5% over the next 30 years. Now, if the government's wise, and we're all wise as a country, with that money that comes into the economy, if we all do something smart with it, I'm pretty sure we can grow the economy together. We can grow our incomes together more than 1.5% to pay for the debt, and the article finished with this one. I think I said it last week, Andy. The article said, I don't think the government's gone far enough. They need to borrow another $1 trillion and build all of these infrastructure projects. You talked about the Ord River and stuff like that. So it's an interesting one, isn't it? Right now, there is, if you think about it, like as a property investor, if someone said, here, Jason, have $1 trillion to buy real estate at 1%, and I know I could get 5% return on my rent, I'd be like, yeah, mate, give it to me every day of the week. Where do I sign? And that's what's happening. Not necessarily as directly tangible into the economy, but the money's cheap. The government's got it, and they're giving it to people who should be able to make more than 1% for the economy, GDP on it. That's just the facts, right?
Well, the real challenge for it is, though, in 10 years' time, or 3 years' time, depending on whether you're using 3, 5, or 10-year bonds, and they're using all of them, right? But the problem,
and 30-year bonds too. Yeah.
So when these cycle out, how much a day do you reckon they're going to have to pay back as principal?
I don't know. That's a good question. I don't know.
It is just
principal. Oh, so how much of the principal do they pay back? Probably nothing. They'll just roll it over.
No. Well, assuming that they actually can't refund it, because when they go to refund it, they're going to be refunding it probably at 2, 3, 4%. If markets change. So rolling it over is going to cost them 4 times the amount. So if you had to take a stab at how much principal will need to be paid back when these things roll over, what would you be saying per day?
Oh, per day, shit. I don't know, $1 billion a day or something. Is that right?
Mate, that's smack on the money. It was like you're reading off the same cheat sheet. It's $1 billion a day that we're going to have to pay back. So that's. But anyway, look, that's tomorrow. And no politician today cares about tomorrow, let's face it. But it's something that we do need to be aware of. But the problem is, the opportunity is that the banks now have this extraordinarily cheap term funding. And so
term funding facilities, yeah.
They don't care about where they used to want our savings and our deposits because they're able to make money on it. They don't care about that now, because they have got a limitless checkbook that's coming from the Reserve Bank or coming from the Fed. Not the Fed, sorry, that's over in the US. But basically, our government funds that are lending out to the banks.
Reserve Bank. At
0.1%. And so the banks are like you said, and I think that we're going to go into a potential lending super cycle, which sounds crazy, but it's so crazy that maybe it's actually spot on the money. Do you know what I mean? Because
money's got to be cycled, right? And this is part of what I think something that's important too, Andy. Just checking in on the comments. Christopher's been out. I've missed you, Christopher. Wondering where you were, mate. Sorry to hear you've had a bit of a loss, mate. Hopefully everything's okay. But great to have you back, mate. And thoughts going out to you, mate. Emily's in there. She asked a question. One thing, Andy, before we move on, can you leverage on stocks like you can on property? I mean, from like in basic terms, often you can't lend up to 90% on stocks like directly, but there is some leverage facilities around, right, Andy? So, give us a little bit of feedback on that. Emily just asked that question.
We've got a few traders on here. I can see Mark's on the call. David, Julie, Shelley, g'day. Annie, good to see you all. It's a good question. So the answer is yes, right? And there's multiple ways that you can do it. You can either take equity loans out of your own home and you can use that. And that's just a simple way of doing it. There's no funky instrument there. You just use funds that you've already got. Make sure you chat with the accountant or your advisor to make sure that the funds that you take out, you isolate the loan amount so that can be deductible.
So have a split, an investment split.
Sure do it beforehand, not afterwards. Chat with your advisors. But then you've got leveraged instruments. You've got things like margin loans. Now, these can be dangerous instruments for people who wield them without. Well, actually, all of the instruments I'm about to talk about have danger associated with them.
So they're derivatives, right? Is this what we call a derivative, Andy?
Well, we're about to get into derivatives, which is what I grew up on, which are highly technical instruments at their core. But margin loans is effectively borrowing against the share portfolio. And what happens if the share price goes down, you've got to put more money back in so that your loan to value ratio of the equities doesn't breach certain levels, right? Typically sort of 60%, but it's been a while since I've looked at the margin lending rates. We're not doing a lot of it.
60 to 70% probably. That's what I've heard of late. So yeah.
So that's another way. So you can actually borrow against the portfolio, but you've got to keep it up. So and that exposes you to a great economy of scale, right? Because you're leveraging the returns, like in property. Then you've got derivatives, right? So you've got warrants.
So before we move on from that one, just a quick compared to what? So margin loan, if the shares do change in value, you have to top the loan up to make sure the LVR works.
Correct.
In comparison to real estate, and this is where kind of the real estate share market kind of has a little competition. Real estate you can leverage at 90%, and it doesn't even matter if the property drops in value 20%. There's no margin loan call. So,
that's assuming that the bank doesn't pull you up on it, there, Jace.
No, it's actually consumer law, Andy, under a residential real estate contract that there's you cannot be called in any way, shape, or form other than not paying the actual loan payment. Now, from a commercial or industrial loan, it's completely the opposite way. It works exactly like a margin loan at the bank. So that's a really interesting one because it's the consumer protection law. Yeah.
So if you have investment properties and you've got a 90% LVR, say you've got a $900,000 property, $1 million property, you've got a $900,000 loan, that property decreases in value to $800,000. The bank can't call 100.
No, it's illegal. It's against the law. It's consumer protection, and that it cannot happen in residential lending, right? So in a commercial, business, or industrial lending, and some people take commercial loans out on their residential portfolios when they have a lot of properties. So this is where the banks get them. I've had a client, and he did this against my better judgment. I told him, don't do that. That's a commercial lending facility covering all of your investment properties. And he took a commercial lending facility out, and that he got called in. But no, the banks can't do it, Andy. If mum and dad have got a house and their LVR drops, they can't be called in.
I've got a question, Mr. Whitten. So this penny just dropped for me because I didn't know that. If you've got investment properties within a trust, then most of the banks don't give you consumer loans, they give you business loans.
Correct. Now that is exactly, and Christopher yelled that out just now. And that is the thing. That is why you will never hear me tell any of my customers to ever borrow money through company and trust structures in any way, shape, or form. As a residential individual, never. Because you lose the protection, the lending protection laws. Now, for business owners, sometimes it's appropriate to own them in companies and trusts, Sandy, but it's actually not smart in any way, shape, or form for most property investors to, when they're building a property portfolio, maybe 3 to 6 properties, to own them in any other way other than their own names. That it's actually safer, more tax effective, and easier for borrowing. When you go above that many, more than that many properties, structures and other things come into play, which actually add some benefit and may be worth looking at. But yeah, it's the thing. Like, it's just, they're so cheeky, these friggin' banks. I tell you, mate. You know, the moment they can have your hook, line, and sinker, they will.
I've wondered for years. So, mate, this is actually working. It is making us smarter. we might be onto something.
Quick, have another glass.
I've always wondered, and I've never been able to figure it out. I've never had anybody articulate it the way that you just did then, and I've never been able to figure out why they're so adamant that even if you're a business owner and your principal place of residence is in a trust. Right, is in a trust. Most of the banks that I've seen, and there could be ones that are out there, because I don't have the the smarts across all of the banks and the loans, but all of the ones that I've seen, they force you to go under a business loan arrangement, and I never knew why they were so rigid about it. But now it makes sense, because you've got the asset protection of the trust, and it's clear. Geez, they're sneaky little pricks, aren't they?
They're sneaky buggers, mate. They're sneaky buggers.
I just got Shelley's just popped in and said, "Never heard of that." Thanks, Jason. Look, that's gold, mate. Actually, I've written that down. I think I'll do some digging into that with you, and maybe launch some more information out there. That's that really does change things up a little bit in that conversation pool, because quite often, you hear the accountants sort of say, well, the trust gives you the protection, but it actually exposes you to some risks as well. And that's a really interesting one to have.
And it's really the challenging thing. Which protection are you looking for? Because you can't be protected for everything under one thing, right? Mm-hmm. So I'd say this to my clients all the time. What is the highest risk that you think that you're going to suffer or have exposure to? So you need to articulate that, because then we need to manage that. If you can't, right? If I go, I don't know. Well, 9 times out of 10, the I don't know means, right, you can't afford to pay your mortgage. And the most afforded protection in lending law in this country is you as an individual consumer under that law. So that's the best protection. Like, even if you don't pay your mortgage today, as an individual, they still can't kick you out of the home. They have to go. It can take between 12 and 24 months for the bank to go through that process. They can't kick you out. They have to follow a certain process. There's certain there's certain ways to delay it. Like it's the most protection you can have from lending as an individual. Any other way, you got no protection. The gloves are off if you lend in anyone else.
That's unbelievable. That's gold. Well, I've learned something tonight.
Sweet, mate.
Like wine makes you smart, and
it does.
Trusts expose you to commercial banking risks and open up consumer laws. So, yes. Mate, that's incredible. That's incredible. I didn't see that one coming, but it's gold.
Mate,
so where were we, mate? We got sidetracked.
I think we did get sidetracked for a bit, mate. But I think you were sort of talking about that $1 trillion worth of debt or whatever. But I wouldn't mind sort of jumping in for a second and just showing a few things in the world of real estate this week. Because yeah, it depends on what you're listening to. Depends on what you're seeing. But here's some interesting thing. Oh, there we go. Look at that. We smashed a residential sales record only about 2 weeks ago in Byron Bay, $22 million, right? So a lot of people thinking, oh, the world's ending, no one's paying any money for real estate. Rubbish. Like, we're breaking records all over the place, guys. The only place that's having a little bit of a tough time, which is Melbourne, and it's the place that's been locked down the longest I think pretty well in the whole entire world.
Yep.
I mean,
we're now the longest. Yep. The harshest.
Yeah. So I mean, let's be frank and realistic. Like, you'd expect some problems to occur because you've been locked down the most. That's not abnormal, even though it's not fun. It's not abnormal to expect that, right? But the rest of Australia is not having that effect, gang. I mean, I'm telling you right now, there are records being broken all over Australia, and including Sydney. Let me show you this one. Paid $10 million above the market asking, okay? In Sydney right now. They rocked up and they paid the coin, okay?
This buyer forgot to read Harry Dent's book. That's gold.
Oh, I tell you. So, shit, mate, the market wants to report, the place where there's the most, the media wants to report where the place is the most pain. And have a check this one out. This is a record land sale at auction in Brisbane over the weekend, okay? $1.15 million for a piece of dirt in Brisbane, guys, okay?
Are you guys locked down there, or are you guys, is there a lot of magic mushrooms going along? What's going on? 1.1 for dirt. Jeez.
Mate, for dirt. Now, it's happening everywhere. 22,000 jobs bloody, in Canberra created, 26,000 people moved from the southern states. Sydney's vacancy rate is lower now than it was when we went into COVID. Every city in Australia vacancy rate is lower than it was 12 months ago before COVID. So the only one that has gone up from an all-time record low of 1.9% for Melbourne across Melbourne is now at 3% or 3.4%. And most of that vacancy is CBD stock because Airbnb has been completely decimated in Melbourne, right? So when you go to Collingwood and look, which is 1K from the CBD in Melbourne, the vacancy, mate, that's 1.2%. And one of my clients just re-rented their Collingwood apartment, which, by the way, got nominated for design development of the year in 2020. Yay! And we put the rent up. Middle of lockdown, COVID in Collingwood in Melbourne. Okay, so anyway, don't believe the negative hype because there are records being set everywhere. Record land sales, record shortage in Perth. Like Perth is, I wanted to get the article. There were 700 people at an open home in Perth on the weekend. I wanted to get it, but I couldn't find the bloody thing. It's ludicrous, right?
Holy shit.
Mate, yeah. Wow. Mate, so, for me right now, there's this two function marketplace where it's like, the people who've, been out of lockdown and the people who are in lockdown. And, I do believe Melbourne's still got a little bit of pain and heartache to go when we're out of lockdown and getting back to work. And then the rest of the country still has plenty of work to do, Andy. Like you and I both know, it's jobs. Let's get everyone working. And that's probably going to take 6 to 12 to 18 months to wash out for us all. Like that's the reality.
And mate, it's a function of these three dynamics. It's a function of that, which we've talked about ad nauseum now, right? Interest rates at zero. It's a function of this, which is this is our budget debt, our net debt, right? So it's a function of, yes, employment and things like that is going to be challenging, and we're going to go through some challenging times. But here's the facts. That's how much we've printed. That's how much the net debt is going up, or not printed. That's how much our net debt is going up. That means there's that much more in circulation. So if we take it to here and we go, okay, well, what is the current debt to GDP, right, of us, right? So we're sitting at around about 9 to 10% of what we produce throughout the whole year has been stimulated into the economy. So that's more money that is generally around the economy, and it's like you said, it's going to flow to somewhere, and because of this dynamic, and I know I keep harping on it, and I was chatting with somebody earlier on today who I know is listening, when all of a sudden there's all that extra money that's sitting around here, and that's your defensive play. Right, your defensive play is to earn 2% over, 1.5% over 3 years, or 0.1% over 5 years, or 1% in a term deposit. When that money hits and it's going to find a home, where does it go? Right, and if people are scared of the markets, and that's the aggressive strategy, so where's the defense? And that's a question that we're asking ourselves a lot at the moment. Like, what is the defensive game? Because when interest rates are at zero or close to zero, then bonds have endless capacity.
I'm not sure I understand.
Well, Siri, you wouldn't understand because you don't know everything. But it's amazing. Siri throws me off everywhere. But bonds will actually lose value as interest rates go up at a point in time in the future. So you're exposing yourself to endless risk and a very, very limited reward. So it's not a very good sales proposition, and people know this. So the money has to find its way into, and this is my belief, right? So again, This is an opinion, don't follow this, but this is what we're looking at. We're looking at real assets, which is property. We're looking at logistical commercial properties for the likes of Amazon and stuff like that. That's one of the reasons I think Goodman Group as a stock has gone so well. We're looking at infrastructure spend. We're looking at all of these real assets in order to actually create a new defensive play. Like, how do you play defense when your go-to defensive strategy has unlimited potential to bring you undone?
Yeah, well, I mean, we talked about this not so long ago as well. Like, so, defense is zero right now. So defense is actually the worst idea. And part of that strategy, I believe, is, if instead of the country or the government taking on more debt, think of it this way: how can we make everyone who's sitting on all of this money that's not in circulation put it into circulation, right? So I'd be really interested to see how much money comes out of sitting in fucking bank accounts and places of just uselessness for the economy, and goes back into circulation, into infrastructure, into jobs, into that stuff, Andy, because they're saying, all right, well, your play now as an advisor would be go, listen, bonds aren't protective anymore. I need to redo the strategy. Let's get you into Goodman's, industrial index or whatever it is. And now that money moves from like literally the bank into, or it like somewhere where it's not really working for the country, and now it starts working for the country. It's probably quite smart. I don't know if that's intentional. I don't know if you could engineer it that way, but I wouldn't be surprised if another couple of $1 trillion doesn't come out of sitting around doing nothing and come into the economy, right?
Well, at the moment, it's happening on wholesale level. So if you're a sophisticated wholesale investor, I can get you into some really interesting infrastructure projects via Macquarie and stuff like that. And it's a defensive play. And I have to be careful of what I say here, because when I say defensive, the ASIC kind of definitions in and around risk profiling are quite severe, but it's defensive assets, government bonds, fixed interest, things of that nature. But for me, I'm going, well, if you can't get a return there and we need to get a yield, we've got to go to the next best thing. We've got to find a defensive play that has a return.
Yes.
So we haven't got all the answers yet, but where we're looking at things like infrastructure, and we found one on a wholesale basis. Now, these things will flow into retail, But here's my line of thinking, right? It's considered to be a growth asset, but if you've got a company that has that is contracted by the state government to build roads, to build tollways, to build an airport, to build these major infrastructures, right? And they're backed by a Macquarie who's done this ad nauseum all around the world, and they need to raise a bit of capital in order to be able to create more significant returns. Well, you've kind of got a semi-state government-backed investment opportunity, don't you? To a degree, it's backed by...
It's kind of like a different way of putting it together, isn't it, really? Yeah.
And so I think that what we're going to see people either stick with the norm, which will be a long, hard journey, or we're going to have to get a little bit creative and go back to grassroots type of investing. Is the most defensive play that you can possibly get while still getting a real return.
Yeah, well, yeah, mate. I think that's kind of cool. I'm interested to see what plays out in this next little bit because, mate, it's a new rules really of investing might be rewritten for a decade. Let's face it, because I think interest rates are going to be super low for a decade. And there is absolute pressure and talk of the cash rate reducing even further, and potentially interest rates reducing a smidgen more as well. But I don't think there's going to be any pressure for interest rates to go up in 5 years, if not 10 years. And I'm just repeating the information that I'm seeing everywhere, basically saying, yeah, nah, it's not going to happen. We need low interest rate environment for 10 years for us to just go for it,
And look, it may well be that it never recovers as far as the interest rate's concerned. And this goes back to an old
Japan
philosophy that, Japan, since the Asian currency crisis in 97, when they had a massive asset bubble that burst overnight and sent them basically into the dark ages, supposedly. They're not in the dark ages now, but they've been living with basically negative or low interest rates now since 97. And they're still a powerhouse economy in many respects. They're not the powerhouse they used to be, but they're still ticking along. And there was, when I was thinking about doing a doctorate, 10 years ago, one of the theses that I spoke to you about a while back was about the velocity of money. And as technology gets better and money distributes and finds its home faster around the planet, does that mean that we have greater capacity to maintain higher levels of average gearing? And the sort of theory was, well, is it possible that every person out there would automatically almost begin their life's journey with 100% leverage? So you're out of university and you have $100,000 bill that you've got to pay off, but that's the normal. Right, that's the new normal. So instead of inflation eroding how much that is worth, you just have that as sort of a fixed benchmark. And I know it's a very abstract theory, but it's got a lot of study behind it. It's never proven or anything like that.
It's what happens right now, Andy. Most people come out of uni with $100,000 of
and it's kind of my point, right? It's kind of my point. We are living with an average amount of debt that is disproportionate to any other period of time. And a lot of the time we're not paying it back, and it gets forgiven. It gets written off by the government. It's really interesting how this is sort of playing out. Or you move into your first house and you exchange it for, $800,000 worth of debt. So it's really interesting. But real estate is going to be one of those real assets as well. And so people are going to start to look at an investment property as a defensive play when they start to realize that there is an undersupply. And then you'll kind of go, well, if there's an undersupply, eventually that's going to have an impact on either rising rents, which all other things being equal should mean higher prices, doesn't always. But people are going to start to look at assets differently when you can't park your money in a term deposit and earn 4%.
Yeah. And made an example right now, my business partner, Sam, you've met him, and a few of the listeners have probably chatted with Sam or heard from Sam before as well. His mum is 78 years old. She's got, $700,000 in a term deposit she was living off. And now she said, nah, I can't live off it. I can't. I have to buy a property. Sam, find me a property. So Sam's been in property 20 years. His mum, has always said, nah, I'm good with my defensive asset. And it's a real true example. Right now, Sam is buying his mum a property with her cash because her defensive asset cannot fund her retirement at all. Like, it's just useless. So, you know,
and look at that for a psychology, right? So look at that for a psychology. I could talk to her about an incredible infrastructure fund. She's not going to understand it, right? So the next level of defense is property. Yeah. And it's not unreasonable to think that that's where the psyche of the population is going to go as well. Because the uneducated investor, not to say the ignorant investor, but the uneducated, so they don't know all of the options. That's all I mean by that. Yeah. They know cash, and they probably don't know about shares. They probably know there's this stuff and it's really scary and horrible. And then they know property because they paid rent.
Yeah.
Where does it go?
Dead right. Yeah, dead right. And it is the challenge, Andy, I think, and this is the part that I really enjoy chatting with you about. You know, ultimately, when we do explain that world of whether a share's a property, the simpler we can make the explanation, the more access, you know, we help people with, because at the end of the day, shares and property are very simple in their simplest forms, but with the idea of derivatives and other weird fucking conversations, that they can be interesting and exciting, but for many of us, just, you know, noodle popping, you know, like, it's like, whoa, I just wanted to get an income. How much do I get for it? You know, like,
yeah, you're right, mate. There's a few questions coming through here as well. There's a couple I might throw to you.
Do it, mate.
We've got fucking Fletcher here, who's asked the first.
Jules.
Good to see you on here, Jules. Does the first homeowner grant only apply to new builds in New South Wales?
Yes, it does. It's only new builds, Julie, or a significant renovation of $150,000 or more. So it's an interesting one, that one right now. We were chatting about it today. So the boost, so the government $25,000 boost applies to an owner-occupier property. It doesn't have to be first home buyer. So just so everyone's clear, Andy, you could move houses right now. You could go build yourself a new house, mate, and you'll get the $25,000 as long as it falls within, you know, the tick boxes. It starts construction before the end of the year. It's brand new. You know, you're the owner occupier, et cetera, et cetera. So Andy, you can get the grant. Jason, I could get a grant if I was doing a renovation and I didn't earn too much. I can't get it because I earn a bit more than it says on the sheet, but it's available to any owner occupier, that $25,000 within the tick sheet. It doesn't have to be a first home buyer.
And she's as she does. For those of you who don't know Julie, she's a phenomenal business owner and pushes the limit in all aspects of life, including holidays and margaritas. She said, can two first homeowners combine the grants on one property?
No, they can't. But Jules, they can do them separately. This is the cool thing. And you know, two young people might be in an early relationship, so they can actually have a first home buyer grant and a government boost grant separately. They're not partners yet, et cetera, et cetera. So, you know, there's some real good things in there. Like, we've done this. I've done it with my clients, like a bucket load of clients in Queensland right now who have ended up buying a property, using the grant, the first home buyer grant, qualifying for the lender's mortgage booster, and also getting an extra booster from, you know, some developers, $5,000, $10,000, furniture pack, whatever. You know, they're putting $15,000, $20,000 of real cash back in their pocket and owning their first home, Andy. Like, that's, you know, it's phenomenal. If you tick all the boxes and you fit into the square, there's about 7 or 8 incentives for first home buyers. Literally, I'm not kidding you guys. If anyone knows a first home buyer or is listening in as a first home buyer, the government is paying you real cash to buy a property right now. They're paying you, gang. So, you know, for you and me, Andy, we don't get anything anywhere near as much as that. But,
well,
you know, back in the...
Here's a question for you from my side of the equation. If you bought your first home in a trust, are you a homeowner?
Well, you don't qualify for any of the grants in a trust. It doesn't
No, but
qualify.
if your real estate was purchased in a trust, and in theory, am I a first homeowner because I've never owned a home?
That is a good question. Technically, I don't know the answer to that one right now. I do know if you've lived in it.
Stop. That's a first.
There's no problem.
He was stumped. He was stumped. This is what episode is this? Like number 7700 or something. That's the first time that's happened.
I don't know to the answer to that. Well, I do know someone I could find out from, so give me 5 minutes.
See whether we can get the answer before the end of the night.
Before the end of the show.
And the last question was from Julie. Is it too late at 60 something to invest in property? And I'll answer that one. I'll go. It's not. It just depends on the reason that you buy it, why you want to buy it, and how it fits into the overall plan for income, capital growth, and retirement. It can be just as good an instrument as any other, but the strategy is the important part. You know, what is the later you get on in life, the exit strategy becomes more important.
Yeah, and I think more important equals the debt level. The older you get needs to be lower, Andy. So, you know, so for you and I, someone who's 60, you know, we wouldn't be saying borrow at 90%. That's inappropriate, I think, for 99% of the situations. But if you were 60 and you could borrow at maybe 50% or 60% because you had some more cash, that's perfectly fine. It's got lots of runway with cash flow, you know. So the asset itself without debt is as good, if not comparable to any share going around. When you add debt in, then any asset, you have to really rethink the asset, you know, compared to age and debt. So I think when you chuck debt in the mix, it becomes you've got to make sure you understand your strategy. Like you said, the exit strategy is, well, I don't want to be 70 and have $3 million worth of debt, because that's kind of, you know, maybe a little bit intangible. What would be the exit strategy? So, you know, it's a good question. I've got plenty of clients, Julie, in their 70s owning, you know, many millions of dollars worth of real estate and living off the income. Their debts are quite low. And, you know, having a chat to Andy about the strategies of transferring, you know, capital gains from one entity, personal entity, into other entities, better tax value entities in strategy is amazing, you know. So I don't know if I can say it live, Andy, but anyway.
I'm just sitting here, I'm going, oh, stop.
This is not financial advice, you like, right? Andy, the financial planner, is falling off his chair. Anyway, I didn't go there. We can,
well done. No, you navigated it perfectly. Safe.
Navigate through that. And if you have any questions, you know, speak to your financial advisor. But I did have a question here from Brendan. Sort of said, financially efficient way of accelerating wealth through subdividing and then selling multiple blocks of land under company and trust structures. You know, by and large, structures are 90% valuable when it comes to tax planning. Okay, that's what they're very good for. Tax planning and tax management. And depending on what you're trying to do, so the outcome needs to be understood at the start. So, you know, what are the things that you want to manage when you buy and sell any asset? Is capital gains tax. You know, that's one thing you want to manage. Any income, you want to be able to manage that. And sort of companies and trust structures allow you to manage those effectively by sharing them across multiple people and parties and bucket companies and all sorts of things. So it's not something we'll go into today. And we might even invite a guest, Andy, to maybe talk through a little bit of this in the tax world. But certainly, Brendan, mate, if you are buying and selling an asset in a short period of time, 9 times out of 10, a company trust structure is usually appropriate for that type of activity.
And it's a sequencing thing, right? It's what asset do you buy in first? And rather than answering it, because that would be advice, the questions that I'd ask on that is, do you need upfront to be claiming tax deductions, right? Because you can only write off tax deductions against taxable income within a trust, whereas you can carry it forward in companies. So the question is a really intelligent question, and if you're on that track, you're on the right track in asking that question. But Jason's right. You need to define the strategy of what you're doing. And here's the thing, you might roll it from one entity to another entity that you own and even pay stamp duty, or in some cases, not pay stamp duty, because you might be doing your own type of funky little development type thing, which I'm not going to allude to anymore. But I think your head's in the right space. And it's a conversation you should continue to explore with your property advisor.
Yeah, and a good accountant at the same time, because I can tell you, Brendan, depending on where you are, whether it's Victoria, New South Wales or Queensland, there's 3 separate answers to getting the outcome. Okay. So, there's a thing in New South Wales called quarantining, so you can quarantine as you enter into a company trust structure, which can minimize stamp duty and capital gains tax. And so, there's a few things that you can do, but you have to define it, like Andy said, right at the front to get it all right. So the outcome at the back is required and achieved. So,
and depending on where you are, to my question that I posed to Jason, in theory, you might actually be able to buy a property in a trust, not be a first-time buyer, sell it to yourself. That's a first. No, that's complete garbage. Please don't listen to me. But I can tell you, I'll be doing some fucking research in and around that one to figure.
Do some research, Andy. Let's do it together. I'm keen to find out that answer to that question. So. Yeah, it's a good one. But mate, hey, listen, we might call it there, because it is, it is past the hour, and that today's chat's gone quick, and I think I've enjoyed the chat today, mate.
Definitely,
really interesting to see, what's going on now in the world of the equities and the stock market, and certainly I'm always interested and curious to hear what you've got to say about what's going on, because it does fascinate me. And hopefully everyone has enjoyed it and learnt 1 or 2 things today. I think that bottle of wine did the job, mate. So you better send me where I can buy that from. I'll be on that next week.
the new Noni juice, to be known as Stein. Think outside the circle from Albert. Yeah. He split the atom and he made a bottle of wine that made you smarter. So his genius never dies. But before we go on, mate, did I interrupt there something?
Yeah, I had one little question here that I might, so Karen Smith, first time on. Hey, welcome, Karen. Great to have you here, mate. She asked a question about SMSF and property and retirement phase. So Karen, what I might do is I might put a pin in that one for next week, and we might chuck a few ideas over the fence. I might get Andy to maybe prepare 1 or 2 slides just in general about that sort of stuff, because I get that question all the time, Andy. And listen, I love the idea of making sure we own whatever asset it is, doesn't matter whether it's shares or real estate, in the most effective structures possible. And both you and I know that a very tax effective structure is a super fund. And there's a lot of questions around how you weave that into your strategy. So it might be kind of cool next week on Friday. I'm going to make chuck Andy a challenge over the fence here, maybe prepare, 3 to 5 slides about, in general, ideas, strategy wise, Andy, mate, making some smart ideas around, tax effectiveness in that space. So certainly Karen's got a great question, and thanks for asking it, Karen. Really awesome. And we'll work around that.
Karen, make sure you remind us at the beginning of the episode, so just in case the wine doesn't make us smarter and we don't remember. So remind us just in case. But
I better write it.
Yep. Given the fact that we should probably bookend this, I just wanted to congratulate you again, Jace, on an incredible podcast launch. So for those of you who've just joined recently, Jason launched the Wealth Faculty. Google it. Go and have a look at it. Help him get to number 1. I want to see him knock off Tony Robbins, Brendan Bouchard, and have an Australian winner at #1 on the podcast slot. So it's on YouTube, it's on Spotify, it's on Google Podcasts and Apple. So check it out. Google The Wealth Faculty. Help Jason. And just before we go out, I'm just going to give you all a little bit of a listen to the man himself, so you get a little bit of a sneak peek before we close off for the night. So have a gaze at this. Oops.
Hey folks, Jason Witten here, your host of the soon-to-be-released podcast, The Wealth Faculty, where we're going to go on an adventure, a journey in discovering what is the true meaning of wealth. Well, what is the Wealth Faculty? Well, there's two things. The faculty that you bring, your physical, mental, emotional faculties, to the idea of creating wealth for yourself into the future. One thing I can tell you, this thing is a marathon, not a sprint. And we need to make sure that we take care of the faculties that we have physically ourselves to make sure we go the distance in this journey. And secondly, who is on your faculty of educators, advisors, you know, the people you rely on to help you with making great decisions on this journey over the next 10, 15, 20 years, creating, keeping, maintaining and passing on your wealth. Well, we're going to interview the best of the best across Australia and New Zealand together and hopefully discover things. And I'm going to get a chance, gang, I'm going to get a chance to interview my faculty of advisors who've helped me over the last 20 years as a professional property investor, a property investment coach, coaching thousands of property investors across Australia and New Zealand, across a table just like this one. And many, many times I've asked the question, what is the true meaning of wealth to you? We're going to discover that answer together on this podcast, The Wealth Faculty. Hope you enjoy.
So, mate, I'm going to finish off tonight, so you don't need to say any more, but delivering that from exactly the same table that you are right now. I'm sure that table's seen a lot of beers, a lot of tears. It's seen some wine and wisdom and seen probably a few thousand conversations in and around wealth. So, mate, this is going to be a bookend of cheersing to you, mate, one of the best I've ever met in the game of helping people achieve their dreams and navigate their way through what can sometimes be a tricky journey of wealth. And mate, from what I know of you, you've done it with more integrity than just about anybody I've ever met in the industry, mate. So cheers to the podcast. Everyone, help it go #1. If you listen to it, you will only be wiser and most probably wealthier as a part of the journey. So before he gets too bashful and says anything else, we're going to sign off for the night. Jace, happy Friday, mate. Damn good to see you. And we'll catch everybody for next week for Wine and Wisdom.